The season is upon us! And no, I'm not talking about Christmas, I'm not talking about New Year's or Valentine's Day, I'm talking about earnings season. Ho ho ho! Merry earnings season, everybody! Just kidding. It's me, Ali, your friendly neighborhood value investor. And today, I'd like to talk to you about something called earnings season. Now, before I begin, just a disclaimer, there is no such official earnings season. When I say season, I'm really just paraphrasing and exaggerating on a period of time where companies release their earnings report. The market affectionately calls this earnings season. As is the case with every official organization in the world, each organization has a financial calendar, and each company can choose the starting month and the ending month of the financial year for themselves. The financial calendar of the company does not have to corroborate with the Gregorian calendar, meaning a financial year of a company does not have to start specifically on the 1st of Jan and end specifically on the 31st of December. The company may decide when to start and when to end their financial year. So usually companies set their start and end in the first 3 months of the year. Just like Singapore's government sets its financial year to the end of the 31st of March. So the first quarter of the year is especially noteworthy for investors like us because it's a volatile season where the stock prices jumps up or it dives in the tens of percentages. That's why earnings season is fun. So what happens usually in this period? In this period, companies consolidate their earnings or losses and prepare reports. For some companies, it may just be another quarterly report, but for other companies, it may be their yearly report because the financial calendar of the company is ending. The market, of course, is abuzz with speculation. Punters will stand ready in front of the screens waiting for each company to release their reports or their earning reports. They will either be hoping for the company to report gains or losses depending on which side of the fence the punters are standing on. Then what will happen is a company will hold something called an earnings call, and earnings call, as the word call suggests, the directors of the company, usually the CEO and the CFO, will set a date and time, and over the phone or internet nowadays, they will share with stakeholders of the company the status of the company. The CEO usually shares with shareholders about the progress of the projects or initiatives that the company had planned, and the CFO will discuss the financial status of the company. So, what's the significance of the earnings season? Well, the significance of the earnings season is that investors, hedge funds, reporters, and a whole lot of people get to see how well they have predicted the outcomes of the company's business. This earnings call will validate investors' standing of the stock and the company. So, for example, in 2022, let's say an equity analyst predicts that company XYZ will do well because they are planning to do action 1, action 2, action 3, and because of these steps, their revenue will grow by 20% and earnings will increase by 5%, and this will happen and that will happen. Then, when the earnings report is released, these equity analysts can see if their powers of prediction actually came true or not. If their predictions come true, then the stock prices of these companies tend to rise, and these analysts are validated. However, if the reverse is true, and then poor thing, the analyst is then proven wrong. Of course, this same philosophy can apply to us as investors. I mean, we as investors also make a judgment whether the company is doing well or not. And from the report, we too are either validated or proven wrong. So the earnings call for us as investors is a good wake-up call to see if the company is performing as it should. Another significant reason for earnings season to be popular is because of traders. Traders watch these earning calls like hawks, and they check if the company does well, traders will usually jump in to buy stocks in the company because they expect the stock price to jump up. And if the company was expected to do well, then very good. But if the company performs poorly, then everybody sells the stock, and these traders will usually sell their stock or do something called shorting the stock. Let's look at Meta as an example. I'm going to look at Meta's stock price. Meta, previously known as Facebook, is a conglomerate of various products such as Facebook, Instagram, WhatsApp, and of course the recently acquired Quest headset, the VR goggles. So Meta has been working on a new product to suit the metaverse, where people interact with each other in a 3D virtual space rather than on the 2D screens of our phones or our computers. So Meta has poured in almost $10 billion into this metaverse project. So what happened was, last year in February 2022, when Meta announced a drop in its revenue and earnings, and at the same time reported heavy costs in development of its metaverse projects, analysts and investors all got spooked off. And what took place was a major sell-off in the marketplace. Within a week, Meta's shares had dropped from $301 to almost $200. That's a 33% decline in stock price. Meta's shares, of course, then continued to decline further in the whole of 2022. But in 2023, the story is flipped. When Mark Zuckerberg did his earnings call just recently on the 1st of February 2023, the report of the fourth quarter and year-end figures, he reported an increase in revenue and net profit. And then he continued to express an increase in daily active people and monthly active people. Both are figures which impressed the analysts and of course impressed the investors. He also shared plans of efficiency, which is to mean that they will cut costs. Guess what happened after Mark Zuckerberg made this announcement? Of course, the stock price jumped up. Well, it didn't just jump up, the stock price flew up, because within 2 days, Meta's stock price increased from 153 to 188, and that's a 25% increase in stock price. So in summary, while earnings season is important, for value investors, it shouldn't be important for the same reason as those punters and gurus. For us, the earnings call is a way to find out if the company is continuing to grow or not, or to find out if the strategy employed by the management is not working or it is working. So naturally, year to year, there will be good quarters of business and there will be bad quarters of business. We should take the long-term view of a few years to track the company's progress. As Benjamin Graham once said, the stock market is like a voting machine in the short run, but it acts like a weighing machine in the long run. I hope you enjoyed this video. If you have any comments about earnings season, or if you have had experiences where your stocks have jumped up or nosedived during the earnings season, please write about it in the comment section, share with all of us. I would love to know more. And as usual, please hit the like button and subscribe button so that we are motivated to produce more videos like this. We hope to see you in our next videos, and take care everyone.